Good afternoon. My name is Polley. I'm a financial advisor with Morgan Stanley. So I'm going to focus on the markets. I graduated from college up in Minnesota, so I'm not from here, but I've been down here about 11 years in 2006. So I went into finance, investments, and to work for Morgan Stanley right before the top of the market, and I got to witness the crash right at the beginning of my career, and I'm still here, so I guess I was either lucky or had good timing. So I understand that you all are not probably dealing with massive 401k portfolios. How many of you own a home? No. Okay, we got some faculty. How many of you have investments in the market? You own mutual funds or anything like that? Okay, so I want to make this as digestible as possible. I know much of college is looking forward, and that's a lot of what we're talking about here. But if I were to ask you, raise your hand if you could probably give what you felt like is a really good explanation of what the financial crisis was. How many of you think you could probably explain that? Okay, that's probably what I thought. You were 10, right? Somewhere in that ballpark. So really what we're talking about, when we talk about the financial crisis and the financial meltdown, it's been mentioned before, it had to do with housing. So housing got completely out of control. Banks, large and small, were lending to people that had no business taking out loans. Prices went through the roof. And eventually, when you pull out one little piece of the Jenga puzzle, it all comes crashing down. And that's what happened in 2008. Pat mentioned this just huge empty period from 2009 to 2016, where a lot happened, but the economy didn't really improve that much. And one of the reasons for that, he mentioned the stock market. Is this all right to use up here? Sure. Okay. So what the Federal Reserve did was they hoped that if they pumped a whole bunch of money into the economy, that things would recover and everything would be okay. Which brings one major concern, and that's inflation. If you pile a whole bunch of money into the economy, prices might skyrocket. The idea with monetary policy is that if you can accelerate money, the velocity of money, you print some, you give it to the banks lend it to somebody else goes and spends it, and that money expands the economy. But here's kind of what happened, and I'm just going to do this really simply. So if we were to go up to, here's the crisis, 2008, okay? The supply of money in the economy and the velocity of money basically were together, okay? 2008, the Federal Reserve decided, okay, we need to do something to fix this. So they printed money, they pumped it into the banks, we talked about the bailouts, and the overall supply of money in the economy went, I'm just gonna call this the money base. If you can't read that, that's fine. Went skyrocketing. But the banks didn't lend it out. And when I say banks, I'm talking more of the big financial institutions that we would think of, the JP Morgans, the Wells Fargos. The regulations on them were so oppressive, they didn't know what was coming. Are we out of the woods? Are we going under? I'll tell you one quick story. When I was first at Morgan Stanley, this was 2008, I can't remember when, but this was the bottom. So we'd mentioned the Lehman crisis. Our firm was days, hours from going out of business. And I was just the bottom end of the totem pole, so I didn't really understand entirely what was going on. But I will never forget being called back into the conference room at our branch in Amarillo. And we all thought, this is it. It's Friday afternoon. They're going to tell us we're not open on Monday. You're going to have to find a new job. And what happened was we had a Japanese bank that pumped a bunch of money into our company, and we survived. From there, we've kind of seen this slow recovery in the economy up until 2016, but the stock market went nuts. So when I went back to the banks, I'm talking about the big banks, this is what happened with actually the velocity of money. And now I say velocity, I mean that got lent out, people bought things, people took out loans. It didn't go anywhere. A couple years after the financial crisis, you started to hear concerns about hyperinflation, what's going to be the next crash. And they thought it was going to be inflation. The problem is the money didn't go anywhere. The Federal Reserve pumped money into these banks and they just sat on it. They sat on it because they were afraid of regulations, which there were tons of. They were afraid of the next crisis. They didn't want to get caught up in that again. And so the money didn't go anywhere, which has really saved a lot of those banks because they were overcapitalized and still are. So when you hear people talk about, okay, when's the next financial crisis? Is it going to happen again? Well, it may, but if it does, it's going to look nothing like the last one. There is so much capital, so much money sitting on the balance sheets of these large financial institutions that wasn't the case back in 2008. So since then, tons and tons of regulations. My job has gotten significantly less fun in the last 10 years. We have to get permission from 150 different people to order tissues. It's been oppressive up until about 2016. So let me fast forward 2016, 2018. Because the economy, finance, the stock market, my job has gotten significantly more interesting since the last election. Let me just give you some brief numbers here recently. And some of this you all can connect with, and some of it won't make much sense, but that's okay. We have currently record low unemployment. I think the last number was 3.9%. It may have touched 3.8, 3.9 a couple times in history. Record low unemployment, and that's across the board. So all social classes, all race, gender, record low unemployment. We have record high business optimism. Surveys are something that we see all the time in finance. So they do a small business survey. They go out and ask a bunch of small businesses, what's your level of optimism? About 2 months ago, we saw the highest recorded survey in history from small businesses. So optimism is high. Wages are up. Benefits are up. And by benefits, I mean 401k matches, health insurance programs up. Taxes are down, both on the corporate level and the personal level. GDP. So you're all pretty familiar with what GDP is. Basically, the growth of our overall economy is over 4%. It has been a long time since we saw numbers like that. Corporate earnings. So next week, we're about to start the next round of corporate earnings where big US companies come out and they announce how much money they have made, how much money they expect to make. The last 3 quarters, those numbers have been up 20% every quarter over last year. And we expect the same this quarter. The companies will report earnings 20% higher than last year. And though most of you said you don't have money in the stock market, if you looked at the market returns last year, they were historic. 20% again coming. So where are we now and kind of what has changed? Inevitably, and I don't want to get overly political, but something that a massive shift that has happened in the last 2 years is that you can no longer separate politics and investments. Coming into the business, I was told over and over again, don't talk to your clients about politics. They don't want to hear it. They may not agree with you. Now, our clients are not shy about talking about politics, but I was told, don't bring it up. Doesn't matter. You're going to lose clients. You don't want to alienate half of your client base by saying you support or don't support whoever's in office. But in 2016 to present, it is absolutely impossible to separate the two. So just to give you some figures of what's happened since 2016 in the economy, we are up from election day nearly 50% in the market. So the stock market is up 50% since the election in 2016. Our economy has grown by $9.3 trillion in a little bit less than 2 years. Something very interesting also happened prior to and after the election. So we get people in our office all of the time who we call wholesalers. They represent different mutual fund companies, ETF companies, insurance companies, and they want us to use their products with our clients. And so what was strange is you would start to see a divergence of opinion leading up to the election based on where their economic advisors were located. So prior to the election, there were two camps, okay? If you were a supporter of our now president, and if you lived outside of some of the major hubs, major cities in America, you were generally more optimistic leading into the election. And the days afterward, after we had the results. On the other end, if you were somebody who did not support our current president and saw him get elected and were from a major city, you had a very different opinion of what the economy was going to do. I'll give you one example. A good friend of mine who's been in all the time came in slightly after the election. I said, "What do you think?" He said, "Well, we think we're going to have trade wars. We think it's time to get defensive. It's time to sell. You need to raise cash. It's going to be really, really rough." Well, that didn't make any sense to me, but I live in a different part of the country. And so I asked him, I said, "Well, where is your guy located?" He said, "What do you mean?" I said, "Physically, where is your economist located?" He said, "New York City." I said, "Well, I'm taking the exact opposite end of the spectrum." I said, "We think that the US economy is going to explode." And we ended up getting into an argument. We're good friends, but my point is, and I actually saw an article on this, which I didn't think I would see an article, but this is Monday. Bloomberg, which is just a financial publication, put out an article about the stock market return difference between Democrats and Republicans from 2016. And again, remember, my whole career I was told, don't ever bring up politics. But it matters, because if you thought the world was going to end because Donald Trump was elected, what would you do with your money? You would get out of the stock market, you would buy treasuries, bonds, CDs, leave your money in cash, and a lot of people did that. Now, if you took the other end of the spectrum and you thought, well, this guy's going to be great, I love him, business guy, what would you have done with your money? You would have bought stocks. So the survey says that if you were a Republican over the last 2 years, you made significantly more money than Democrats. And that really has nothing to do with whether you're a Republican or a Democrat, other than politics now affects the way people invest their money. And we see that all of the time. So my first question when someone comes into my office and says, well, here's what we think, is, well, where are you located? And if they're located in a large city, generally speaking, they're going to have a different view than an economist who's located in a different part of the country. Florida, Colorado, somewhere in the Midwest. So it's inescapable now to separate what's happening in the political world and what you do with your money. It's on the news all the time. Tariffs. What do you think about tariffs? Well, if you thought tariffs were going to end the world, as people were actually saying, then you would have done X with your money. If you thought, no, this is going to be positive for us, you would have done Y with your money. And so that's probably the biggest thing I have seen recently in the last 2 years, is that that conversation happens all of the time now. And it's not a, where do you fall on the political spectrum? We can't get along. It's simply, what is your view of the world? And your view of the world now greatly impacts what you do with your money. So moving forward, and let me give you one other example. This is from my own firm. So I printed this article. This goes back to February of this year. If you were paying attention, which many of you probably had no reason to, but at the beginning of this year, we went from record market highs to higher record market highs in January. February, we had a sharp, fast correction of about 10%. And so you had people totally split. This is the beginning of the end, or no, this is just a slight correction, and we have a lot more to go. So Morgan Stanley, if you're recording this, don't send it to my people in New York. Morgan Stanley was all over the news with headlines like, Morgan Stanley says stock slide was appetizer for the real deal. So our people in New York and overseas were saying that this is just the beginning. Later in the year, we're going to get the real thing. And all over our social media, so we're trying to be very technology, very relevant now. We have social media. You can follow me on LinkedIn. But all of our suggested posts from the company were raise cash, get defensive, which here in Amarillo, Texas, we didn't believe. So there was a divide even within our own firm. So our company was out in February telling you to raise cash and get defensive. Well, if you were watching the stock market this week, new all-time highs across the board. So even within one firm, you have these divides of where are you located? How do you view the world? What do you think is going to happen? And that's something that never used to be the case. There were analysts that you would look to and they would be apolitical. It didn't matter. We were just looking at numbers. We were just looking at individual companies, and that's no longer the case. Everything is global. Everything is political. And it's not that it's necessarily a bad thing. It's just something you have to take into consideration when we invest clients' money. And that's probably the biggest change I've seen here over the last 12 to 18 months. So with that, I think we're going to leave some time for some questions. Good? Okay.
Thanks, Mike.